SDF or anyone necessarily on this panel endorses any of the views expressed. So with that kind of stage setting, let's jump into introductions. So today we have Alex McDougall from StableCorp and Dante Disparte from Circle, who will share their opinions from the perspective of two different approaches to fiat-backed stablecoins. So I'm going to ask for quick intros so we can get to the meat of the program, but we'll start with you, Alex.
Fantastic. Thanks so much for hosting. Excellent programming already today, and really excited to dive into this. I'm Alex McDougall, President and COO of Canada StableCorp. We are issuing a bank-issued stablecoin called VCAD upcoming in Q1, which is actually a digital deposit receipt. So adding a new wrinkle into the public versus private discussion. So really interested to work with my colleagues today to flesh out some of these issues and dig a little bit deeper. Going to be fun.
Great. Thank you so much for being here. And we will move on to Dante, who is at Circle.
Hi, Candice. Really an honor being with you today and looking forward to the discussion. So I am Circle's Chief Strategy Officer and Head of Global Policy. And for those who may not know, Circle is to banking and payments what a Tesla is to the internal combustion engine. We're trying to modernize a lot of the core infrastructure around how money moves, including being the issuer of USDC, a dollar digital currency that enjoys the powers of the internet and the fundamental trust in the US dollar.
Great, welcome. I had not heard the Tesla comparison yet, but it's already got all sorts of thoughts in my head. And then, so from the CBDC perspective, we have Josh Lipsky from the Atlantic Council, who they're the ones who bring us that great tracker of CBDCs, and Simon Chantry from BIT, who's working with central banks and actually working on deploying CBDCs. So Josh, I will turn to you for a quick intro.
Well, thank you, Candice, and thanks everyone. It's really a pleasure to be here and looking forward to this conversation. I'm Josh Lipsky. I'm the director of the Geoeconomics Center at the Council. I was previously with the IMF, and behind me is the tracker that's been referenced, our interactive CBDC tracker. And I'll just make one note to what you said, Candice. We're now up to 90 countries, not 87, in pursuit of CBDC. And I'm sure we'll get into all of the different design choices they're thinking about in our conversation. Looking forward to it.
Great, thanks, Josh. I meant to ask you that right before, because I know that that's why we're here talking about it, right? This is an ever-moving conversation, and more central banks and private companies are jumping into the space. So our final panelist is Simon Chantry from BIT. And Simon, I'll turn it over to you.
Hi, Candice, and pleasure to be with you today and with all the fellow panelists. I'm Simon Chantry. I'm co-founder and CIO of BIT. BIT offers a full stack digital currency management system for central banks. We have some of the most progressed CBDC pilot projects in the world. I should say that I do recognize the importance of stablecoins, and our offering actually does also serve stablecoin deployments, one of which we're actually rolling out in Belize now with the National Bank of Belize. I do think that there's a lot of similarities in the technology stack, and I hope we get into that today.
Great. Yes, I think it is. We've set this up as a debate, but as we know, there's a lot of crossover between CBDCs and stablecoins. And so I hope that we've created prompts that will allow you to not feel like you're trapped in picking a position, but free to talk about your views of the two options. And perhaps by the end, we'll talk about whether they are really options or they're just two different varieties of achieving these goals that we set out earlier. So the first debate, we're going to get into it. We'll turn to Simon and then Alex. And as you can see, we have a timer running, and I'm going to ask you to limit your initial responses to this prompt to 2 minutes each. I'll try and jump in and stop you if I must. And then you'll each get about a minute to respond to the other. And so with that, the first topic, according to a recent McKinsey report, collectively, nearly $3 trillion in stablecoins such as Tether and USDC were transacted in the first half of 2021. Given the prevalence of stablecoins, should governments let the private sector continue to lead the way on the development and deployment of these digital assets? And then governments can focus their attention on crafting appropriate regulations to bring certainty and protections to this space, instead of trying to recreate the wheel by creating their own stablecoins in the form of a CBDC. So some of you may have small screens. I'll read the actual prompt is innovation is best left to the private sector. So I will start with you, Simon.
Thanks, Candace. Happy to kick us off. So look, I do think that the growth in stablecoin market cap and transaction volume is impressive and definitely significant. I would argue that the innovation both on the CBDC side and the stablecoin side has been driven by the private sector. And I can tell you that firsthand, that for years we were knocking on central banks' doors saying this is an inevitability. You will need to upgrade the technology behind your currencies. And what's funny is that before before July 2019, and those of you who watch this space closely will know that that was when Libra launched their white paper. Prior to that point, central banks didn't pay us much attention, and immediately after that point is when they actually started paying more attention. And I think so I would argue that, again, innovation has been happening in the private sector, and it's happening on both sides. It's happening on stablecoin sides, and it's happening on vendors like BIT, who service financial institutions and service central banks. Again, I would say it's an inevitability that both are going to exist. I do think that these are just iterations of payment tools and value transfer tools that are brought about because of the internet. I always come back to the fact that the internet itself is evolving and changing industries in many different ways. And this is just another one that the internet is changing. So I think we're going to continue to see innovation on both fronts. And I do think that there's a lot of crossover. As I mentioned, BIT's digital currency management system, it suits central banks and it suits financial institutions. There's a lot of similarities in running a stablecoin deployment and running a CBDC deployment. Now, where our feature set gets augmented is when you're talking about the implementation and the adjustment of monetary policy in real time. That's where obviously we specialize for central banks. But I'll pause there. I don't want to take
perfect
too much
timing.
time.
You're
Candace,
watching the clock. Thank you, Simon. All right. So Alex.
Fantastic. No, I think there's absolutely innovation that happens at both layers, but I think it's a very different type of innovation. I mean, we've organized our private sector structure to be dollar value maximizing. That's the way we've organized our corporate structure. That's the way we've organized our governance. That's the way we've created private institutions. And that leads to a certain type of innovation that's very powerful, very explosive, and very oriented around a commercial space and a commercial mindset. And the point of our public sector is sort of to fill in the gaps and maximize for collective well-being and maximize for these collective action problems. And where the private sector gets weird, or it breaks, or it does things that are objectively against the broader well-being of an organization or a country. But that's a lot harder to maximize for. What are we maximizing for from a public sector perspective? Is it happiness, GDP? Is it wealth? It's a much squishier problem. And so when we think about where innovation happens at the private sector, it can be very powerful and very explosive and very fast. On the public sector side, it needs to be these bigger kind of issues, and it needs to be more around models and governance structures and things that are less able to be solved immediately with technology. So when we're looking at how we sort of replumb the infrastructure and how we kind of redo the infrastructure of our payments and our financial system, it's a bit of a mix of the two. It needs to be driven from a tech perspective, and I think this builds on what Simon was saying, of even the models that we're using to work with our public sector are driven from this private sector mentality of innovation. But there's a huge onus on the public sector to manage that properly and figure out where those breaks in collective action are and innovate on the governance structures that oversee that. And as the private sector tech gets better and better and better, it becomes harder and harder and harder to do. So I don't think it's technology innovation that needs to be prioritized at the public sector level. It's model innovation, it's governance innovation, and leave the technology innovation to the private sector, which is generally the driver of it.
All right, Simon, we'll give you a minute, or a little less than a minute now, but a minute or so to respond.
Well, Look, I think, Alex, your comments are super timely, especially because the BIS just released a new paper or an iteration of the paper today on governance and with distributed ledger technology, governance of money with distributed ledger technology, which admittedly I'm not through all the way yet. So I'm looking forward to seeing their thoughts on that. But I agree, governance and policy surrounding these will be a real challenge. But I think we're seeing progress on that, especially with the President's Working Group paper and whatnot, which I should commend Stellar for their contributions on that as well. So I do think I recognize what you're saying, that technology innovation is certainly happening at the private sector, and it always does. It always pushes at the private sector. But Candace, sorry if it's a little boring, but I agree with the.
No, I know. That's what I know. That's, as I said at the outset, I think that there's a lot of it's not necessarily a black and white question, which is why it's good for discussion. So Alex, we'll give you the last 30
Sure.
seconds.
Yeah, and I just want to build on the BIS angle. I have some quibbles with their micro approach to digital assets, but overall, I've found they've done a good job of putting some level of black and whiteness around quantifying what is like the old world and what is new, and really sort of drilling in on what is new and trying to put some guardrails around that. And I thought their way of approaching stable coins or stable assets in their previous report was prescient of, well, okay, what's the underlying, and then what is the tether or the new thing that's being created on top of it, and let's really focus in on that new piece. And that's to me is a good way of sort of productively separating the two. Allow the private sector again to really kind of build the tech that underlies it, and focus with BIS and organizations like that on understanding what's new and trying to put guardrails and models around it.
Yeah, I think to me, this feels like an area where we really, really need to push on that public-private partnership and figure out, like, how do we not redo what we've done in the past, which is the private sector, the innovators, and the public sector are slow and behind. Like, let's figure it out. This is the place to really figure out how to work together and get to the right place for the people. So really interesting to hear your perspectives, and I'm going to keep on schedule here, and I'm going to move on to the next topic. And this one, we're going to start with Dante, and then Simon, you get the last word on this one. Give everyone a chance to be first and second. So again, 2 minutes each, roughly, and then about a minute to respond. So the topic. As anyone who has any involvement with the Stellar ecosystem knows, we are all in on the power of blockchain technology to improve access to the financial system. It's encouraging to see how consistently this goal appears in the CBDC discussion, coming directly from policymakers and central banks. So for the purposes of this topic, let's assume that financial inclusion is paramount. What is the best way to achieve that, through CBDCs or stablecoins or both? So again, for those with small screens, the prompt is: central banks are better equipped to address financial inclusion. Dante?
Oh, great. Thank you, Candace. So I would not want to stand on a panel, let alone a debate, with such intellectual juggernauts unless I came prepared to win. And so at first, I must apologize as one of the people who was one of the founders of the Libra project. My apology is that it, probably more so than any other initiative, galvanized the world central banks to try to pick a technology stack and compete in this space. However, the operating model, as much as the scorecard of public sector digital transformation and public sectors picking winners and losers, is very checkered. It's very bad. And I think we should be very, very watchful. And I'm glad there is such a tool as the Atlantic Council's CBDC tracker. And in my view, a watch list of where the potential of unchecked public sector innovation and disruption, looking at the two-tiered banking systems, payment systems innovations, is likely to emerge as a risk that will erode privacy, a risk that will erode the ability to have a censorship-resistant form of money, and ultimately a risk that will not advance financial inclusion priorities. As you know very well from not only my work, my advocacy, but also what Circle stands for. We absolutely believe that you could raise economic prosperity for billions of people around the world, but you cannot do it if the only operating model for banking and payments is enshrined in brick and mortar. And the central banks of the world, as many of the global institutions around the world, have had a monopoly on solving for financial inclusion. for hundreds of years, right? And yet the scorecard until very recently has remained checkered. We have 1.7 billion people around the world who have no access to the banking system, yet 1 billion of them have an access to a low-cost internet-connected mobile device. My premise is very simple. Until we all collectively, every single one of us who has a shot at bending the arc of Moore's law in the favor of humanity, such that every one of those internet-connected mobile devices becomes a part of a compliant payment endpoint, we should not cease. Now, the form factor that the money takes in its digital form, a central bank digital currency is a domestic payments innovation to the extent it is even deployed. And I think there too, it poses enormous complexities and enormous risks. But to the extent that form factor of money can exist in the way that USDC does, which is a dollar imported onto the internet and inheriting the internet powers, it then becomes a cross-border payment instrument. It could address remittances, which are a bigger cash flow than foreign direct investment and official government development aid. And it could start to pull billions of people into lower cost payments, cross-border payments, domestic payments, and so on. This innovation is not an abstraction like CBDCs, it's real.
All right, I'm gonna move it over to give Simon a chance to respond.
Okay, very, very well said, Dante. And again, I agree with a lot of your points. I'll sort of harken back to one of my initial comments, which I believe that central banks, as you correctly pointed out, are in a tight spot and feel the need to innovate. Now, given the classification that central bank money takes on itself, it is the most risk-free form of money in a financial system, given that it doesn't bear institutional deposit risk. Again, I think it's a natural evolution of central bank money that it will be extended to households and individuals. I think the reason it hasn't been extended past notes and coins thus far is more so the result of a growing national economies. And now that we're faced with globalization and rapid technological innovation, you see that forcing central banks to recognize that they need their own in-depth technology strategy to evolve their own currency. And so I think the same arguments that you made for stable coins offering beneficial features and access to all kinds of different pockets of society, I think the same can be applied to CBDCs. Now, I'm also concerned about privacy and accountability for the operators of these systems, absolutely. And it's something that I think the standards work can be accelerated greatly and should be accelerated greatly, especially in the US. I wrote a piece last week that was kind of like a call to action that we're looking for, and I believe the world is looking for the financial leader of the world, which is the US, to step up and establish standards for accountability, transparency, for privacy protection for all who touch CBDCs. So that's definitely close to my heart and close to the work that we're doing at BIT. Fascinated with the technology solutions that are coming out that will protect against privacy, but again, I think they can be applied to both stable coins or CBDCs.
Dante?
So one of the challenges broadly, one of the big challenges that I have about a lot of the arguments against stablecoins and the arguments in favor of CBDC is that we're all concerned about consumer protection, so much so that we would rather keep billions of people on the margins of low-cost payments and financial services, assuming that we as individual actors are not sufficiently enlightened as to what the buyer should be, where we should have buyer beware disclosures. And so we're trying to create, not only did we go through a short-term stablecoin purity war about what were the prudential assets backing stablecoins, but we're also now trying to effectively have many of the world's central banks compete with their very banking systems and their very private sector innovators. When in reality, the air gap between the central bank, where you want to have monetary policy preserved, and the banking system is a feature, it's not a bug, right? Most value-added money in circulation today, 95% of it is in fact riding on private rails. Banks that have leverage and banks that follow a fractional reserve model are effectively creating money. We just happen to be doing that in a form factor that imports money onto the internet. And I think it gives us the highest prospects of extending the dollar and other trusted currencies around the world for an always-on global economy. Our financial needs don't take bank holidays, but the banking system does. I have very little confidence that a central bank digital currency will ever meet any of these issues domestically, let alone in a cross-border setting.
All right, last 20 some seconds, Simon.
I guess all I would say is that they will need to, if they're going to be competitive, right? They will need to meet those requirements. They'll need to be 24/7. They'll need to be interoperable with other CBDCs, or firms like BIT haven't done our job correctly, right? And so I think that will be the evolutionary path that we see for the technology and the deployment structure of CBDCs in the coming years.
Yeah, I think both of these topics have sort of highlighted this this role of government, and I think the pace of the CBDC process versus the private sector, which always moves more quickly. There's obviously always this question of, is there a role even before CBDCs are issued for the central banks and the governments to set some standards, even if they haven't even decided whether they're going to go forward with their own CBDC. So. All right, gosh, we really need more time for all this. Next topic, this one is for Alex and then Josh, and same time limits apply. So another critical issue is privacy, which has already come up. Moving from cash to digital means creating a digital record of transactions. On open public blockchains, these records are immutable and transparent. We all know that privacy standards and expectations vary widely from country to country. Presumably, a central bank will apply their own privacy standards to their CBDCs, and they'll need to incorporate the government's need for transparency. Moreover, many central banks are looking at the programmability of CBDCs as a means of dictating how and for what a CBDC can be used. So does the very notion of a central bank issuing and controlling these digital assets move the needle on privacy in the wrong direction? And does it create unnecessary hurdles with respect to interoperability from country to country? So that's a lot in one, but CBDCs move the privacy needle in the wrong direction. Alex?
I think given, and I'll go back to my innovation at different layers comment before. I think without innovation at the public sector level, it absolutely does. I mean, we've created structures within our public sector right now, and within our our highly regulated financial institutions as well, where they're basically asking for maximum transparency that's possible. And there's a limit on what's possible in our current financial system with cash, with bank records, with the transactability. And we don't have a great fundamental infrastructure of our banking. And that's both a feature from a privacy perspective and a bug from a transparency and an AML perspective. When you replumb all of that with a completely auditable, infinitely storable, and infinitely viewable Batman machine, for lack of a better term, that's terrifying with our current institutional mindset of more. And our public sectors do have not a great record with privacy, and some of that. So without the innovation in the actual models, and some of that can be technology driven. I mean, the blockchain industry has done wonderful work around managed privacy, so zero knowledge proofs, zero knowledge data, a lot of those pieces. So should we be solving the privacy gap that's created by more technology with even more technology? Maybe. Can we solve it with better models of how we're looking for and what we're really looking for? Probably a better scalable solution. So yes, it absolutely does move the needle in the wrong direction unless we can create better models for how we're actually governing these things. On the flip side of that, it creates an incredible opportunity for complete universal machine speed knowledge about what's happening and where flows are. The amount of information that comes with a fully blockchain financial system is exponential multiples of what we have today. So great opportunity, but also terrifying with our current governance.
All right, Josh, finally you get to speak. I know you wanted to chime in on all these things, but go ahead.
It's been difficult to wait. Okay,
I've been watching.
I'll jump in. Let me debunk some myths that I think I heard today and or talk broadly about CBDCs, and then I'll answer the privacy question. First of all, central bank digital currencies are happening. 90 countries around the world are exploring central bank digital currencies. It is not an either or choice between central bank digital currencies and stable coins. These things can and should coexist. And to the extent countries are exploring pilot projects, the 16 countries that have pilots, they do it in coordination with stablecoin deployment and cryptocurrencies within their own economies. They do not disintermediate the banking system. Every country that's deployed a CBDC does it in a two-tiered model through the traditional banking system, including China. And speaking of China, the boogeyman in the room that often gets touted out to say, oh, but China, look what they're doing. There are 89 other countries and models to think about when it comes to CBDC. China gets way too much airtime, in my opinion. And that brings us to the privacy issue, which is the focus of this topic. Yes, CBDCs can produce privacy risks. So can other technology companies. I think we've seen that recently. There are privacy risks with any kind of digital payments that have to be well regulated, that have to have oversight. But it's about design choices. It's about how you build a CBDC. And I think the mistake that's made is for people to come and say, oh, this could be abused, so we shouldn't even try it. That's wrong. This could be designed correctly. It could be designed wrong, but we need to look at the models like the Riksbank now in Sweden that are looking at privacy, where they have tiered wallet systems, anonymity below a certain level. These are good models to follow. And Candace, finally, to your point, you talked about the US and standard setting. Yes, completely agree. Because in the absence of the US putting something on the table to address these legitimate privacy concerns, China's model will proliferate. There are cross-border testing right now with China. And so that's the challenge. Don't back away from the playing field. It's not about CBDC dominance over everything. It's about CBDC complementary in the digital ecosystem.
All right, Alex.
Yep.
Response?
No, well said, Josh. I appreciate your points on there, and I think it's a similar view to mine of designing the right structures and designing the right governance, and then allowing the tech to be machine speed within those parameters. I feel like I have a little bit less faith that there will be a voluntary ceding of control, for lack of a better term, and a material change in the way that we've kind of moved our privacy needle existing from the public sector, which has been a gradual and not that gradual erosion of individual standards. But I remain eternally optimistic, and I think that there's what's really cool about the blockchain space is that you can hard code black and white in machine logic what the privacy standards are, where right now we're sort of relying on a bunch of loopholes and a bunch of lack of clarity around what the rules really are. And I think regimes really drive trucks through those lack of clarity. Whereas in a blockchain world, if you agree on it once and you code it into the standard, then privacy is guaranteed. And so there is hope for it, but we need to have the right people, the right drive, the right force, the right governance structures, and the right execution mechanisms. And I very much hope that the Atlantic Council is driving that forward.
And Josh, I'll give you the last 30 some seconds.
We are trying, and along with a lot of other partners, some on this call. So I totally agree with what you said. We have to prove it. Countries have to prove that they can do it, and they will have to compete with private sector options. The only thing I would say is don't let the legitimate privacy concerns make you not even attempt to do it. And there are enormous benefits for a CBDC that I believe a stablecoin itself could not provide. And I just give the example of stimulus, of taxes. There are some core government functions that I think a central bank like the Federal Reserve or the ECB will want to retain for themselves and their finance ministries. And we should not leave that amazing technology on the table that could help people because of the design concerns that I think can be solved, but have to be proved that they can be solved.
Great. All right. Well, I have lots of thoughts, but we have to keep moving on to our next topic. And this one is for Josh and then Dante. So in the United States, the President's Working Group, which we mentioned earlier, or the PWG, recently released a report on stablecoins. And they did not seem to think that stablecoins need to be squelched or replaced with CBDCs, but they did recommend that only federally insured depository institutions be allowed to issue the tokens. And they cited a whole host of concerns and risks, like runs on the market, and I won't get into all of them. I think many of us have read the report. So the question is, are only banks, central banks or private banks, the ones who can be trusted to issue coins safely? So we'll start with you this time, Josh.
Sure, and here's one where we'll see. Dante and I may not disagree as much as we think. I think we have to get out of this mode of thinking about, what is a traditional bank? That's an old way of thinking about the system. And to the extent the presidential working group had maybe an overly narrow definition of what is a bank and what is a private service provider and a financial payment provider, that's not the right way to think about it. I think there are other institutions that can provide stablecoins, can provide dollar-backed assets that aren't traditional banks in the way we think about it. They have to be well regulated. There has to be oversight, but it doesn't have to be just the traditional banking system in that way of thinking about it, because I think that gets to the core issue of what many people on this call have been saying, which is don't crowd out innovation in this space. And so, this idea of a bank, we have this old brick and mortar model that Dante talked about. That's not where the global economy is heading. That's not where digital payments are heading. And so it's overly restrictive to say that. But what it really means is that you need stability, you need liquidity. I know this is something Circle focuses on and others as well. That's really what the PWG is getting at. And maybe the terminology bank, as Fed Governor Waller said today, is probably an overly restrictive way of thinking about it. But safety, stability, limiting volatility, security, preventing runs, protecting consumers, that's the way to think about it. And if other companies can do that and can be regulated and licensed and oversight, then I'm all for that.
All right. You did not mention the word insurance, but I'm going to move it over to Dante to respond, and then we'll come back to you.
Yeah, so nested in the President's Working Group's report and the idea that stablecoin issuers should be insured depository institutions is a really, really important concept. And so if in fact the world is in a digital currency space race, as the Atlantic Council has been tracking with the advent of CBDCs and interest in CBDCs around the world, and as very ardent and passionate advocates like Chris Giancarlo have been describing with the Digital Dollar Project, then the way the quote unquote West will win this digital currency space race is through a simple policy decision that has nothing to do with technology. It is to decide whether or not we can confer digital legal tender status to form factors of money that are already in circulation, like in the European Union, the concept of e-money, or in the United States, what is today regulated as money transmission. That's a policy decision that has more to do with legality and less to do with which type of institution can be an issuer of money. Again, most money in circulation on the planet today is value added. If I came to you and came to the world with an innovation called cash, by today's regulatory and financial crime compliance standards, it would not be approved because of its opacity, its lack of utility, and in the context of a public health emergency, the ability to be a vector for spreading a disease. And so some countries physically resorted to laundering their money. Now, while Circle has asserted well before the PWG issued its report our intention of becoming a bank, the reason we want to become a bank is we actually think we import good conduct and good prudential conduct into the banking system, bearing in mind that our business model is fully reserved. Every USDC in circulation is backed by cash and short-term government treasuries. It's the safest asset class we can get. And so the idea of becoming a bank is about all of the other economic activities that we can support as a bank. But I do not think a one-size-fits-all approach is appropriate to continue promoting innovation. So now that is the policy issue that we now face in the US and in Congress and in the Senate and elsewhere around what does the future of money look like in these new form factors.
All right, Josh.
Yeah, I mean, two things, and I agree with a lot of what Dante said. The first is on this insurance issue. We heard from speakers earlier this week on an event we did. There's a real risk about importing some of the what we would say, who cannot qualify, unlike the Circles of the world, some of this instability into the FDIC and others. And that's a real risk with some of the things that were recommended by the PWG. But the second thing is, what are we asking these companies to be? And what does it mean from a banking perspective? We have a fractional reserve lending system that basically undermines and basically fuels our economy. So it's a really important question of what we are expecting of these companies through regulation, because if it's about private service payment providers or it's about lending, those are two very different things. And we don't require traditional banks to have one-to-one liquidity. That's how the fractional reserve system works. So I think there are real questions raised. And that's why I think the bank terminology itself is not as useful as to what sort of stability, insurance, yes, Candace, to your point, liquidity are we expecting from these institutions?
And on that very topic, I mean, what a world we're living in. Yesterday, we announced an initiative called Circle Impact, in which we will begin allocating what we hope is billions of dollars of USDC reserves into the US banking system, specifically into minority depository institutions and into community banks. We think that's a pathway of strengthening the balance sheets and therefore strengthening the communities those banks serve. But also it is a very blockchain-based approach to thinking about distribution, thinking about the share of risk, and thinking about how we can allocate capital, governance, and sort of opportunity much more equitably. For the future of money and payments to be more equitable than the past, we need to approach this in radically different ways. One other small indictment I have of some of the President's Working Group's recommendations is that, and this is happening similarly at the international level with the principles of financial market infrastructure that I'm sure we'll touch upon briefly, is that they're trying to back these technologies into closed proprietary systems. We are introducing competition collectively against the walled garden problem we have in payments. How useful would your email be if you could only send an email to a Yahoo user and not a Gmail and Hotmail user? A lot of the core of innovations with public blockchains on how value is transferred is a protocol for an open internet of value. All of us collectively, whether it's a CBDC or a stablecoin, should continue fighting for that more open version of the future.
Yeah, and I think we talked about this a little bit before when we all met, that we don't have a representative of a stablecoin that is algorithmic or like introduces those other issues with respect to stability and some of the things that we're all talking about. But next time we'll bring that to the table. All right, but we're on to the last prompt already. And I don't need a lot of intro for this one. And this one, I'm going to give you each 2 minutes to address. And we're going to go in order: Alex, Simon, Dante, Josh, just so you know. And the question is, can and should stablecoins and CBDCs coexist? So Alex?
Yes, they can. I mean, this is a technology that is designed to create and foster interoperability. Now, should they? If we end up in a run rate CBDC world, my view is that we sort of take off some of the like crazy potential exponential upside associated with the blockchain world. This idea of cryptopia, where everything's on chain, we no longer have fiat currencies, everything is entirely machine speed. And maybe that's completely unrealistic regardless. I think CBDCs and to a certain extent, stablecoins are wonderful bridge technologies to allow us to use our existing financial models, use our existing way of understanding the world, and move towards that potentially entirely inclusive machine speed world that has no frictions that I described a minute ago. Now, I think CBDCs, and I'll sort of sum it up with saying they have a very high floor of what they can use as the result of implementing blockchain technology, but I think they have a very low ceiling as well. It's going to be an evolution of our current model, which is fine. It's great. Everything that's an evolution is okay. But if you think about it, it's like a discounted cash flow valuation instead of an option valuation. You're taking out some of the wonder by having it be basically a replication of our existing system. And maybe it won't be, but if you look at a ton of the technology innovations over time, where they get captured and where they end up within structures is incredibly predictive of what the ultimate impact of that technology is. So back to my initial point of, unless we evolve the structures by which we are using these technologies, an implementation of CBDCs will end up with an evolution of our current structure instead of a revolution that is possible and on the table by a complete deployment of open blockchains.
All right, Simon, 2 minutes or a little less.
I like it, Alex. Yeah, look, I think one of the things that I bring up in my discussions with central banks is the need for them to recognize the innovation that's happened in the open source community and in crypto and stablecoins over the last decade, and for that to inform their decisions, not just around technology and feature sets, but also around configuration and policy. Now, to some that may seem incompatible. You're talking about permissionless, decentralized structures. However, these ultimately translate into features and use cases and assurances that have been accepted by the growing crypto user base. So again, I think it's super important that central banks in their consideration of CBDCs look at and study what's happened in crypto, and not just as some obscure anarchistic or shadowy supercoder innovation, but rather as a groundbreaking open source movement, the likes of which brought us Linux and many other open source developments, an incredibly important infrastructure from the open source community. This is a similar, if not more important, contribution to societal infrastructure. So to bring us back to the prompt, yes, I do think that they can coexist. It'll be interesting to see where the lines are drawn and how far CBDCs reach as far as use cases go versus where stablecoins fill in for those use cases or vice versa. And certainly stablecoins have a massive lead in terms of pushing innovation, pushing increased adoption and users. Very, very excited to be a part of it on both sides, and definitely see the need for the standards work. And so Josh, I think I'll be in touch with you on that. But yeah, thanks, Candace.
Yep. Dante?
So I don't want central banks competing in this manner any more than I would want the FAA building aircraft engines and flying planes. I do think, however, there is a role, and a massively important one, in which the designated airspace and the designated safe conduct and the safe sort of operators around innovation on how money moves should continue. For the future of money and payments passes prologue. Visa, MasterCard, ACH, international wire transfers, all of these networks are the sum of the parts of private sector innovation and private sector activity. The second big tech said it could start to innovate at scale, the central banks got agitated and started to compete. The second we started to see the geopolitical stakes raising, and then the question of should the West try to out-China China with its own digital currency directly issued by central banks, we started to debate what were the merits, what were the risks, what were the opportunities. On that very subject, I've submitted evidence to the UK Parliament on the to CBDC or not to CBDC question. It is an important policy debate, but my argument is our best chance at competing for a more inclusive, more equitable global financial system is to continue to allow this wave of open source infrastructure that supports privacy preservation, the movement of value, the ownership of assets, and pulling stranded assets off the sidelines all over the world has to continue at scale. No single country can do this alone, any more than no single private sector actor or stakeholders could do it alone. And this is what we love at Circle about the idea of being a part of an ecosystem. So I don't think we win this debate unless we figure out how to really continue deeply collaborating.
Great. All right, Josh, you get the final word. You were the last to speak, and now you'll be the last to speak.
I appreciate that opportunity. I agree with Dante on the collaboration, but I don't agree on the FAA analogy. Money is not an airplane. It's not a cell phone. It's not even the internet. It's sovereignty. It's fiat currency. It's part of what makes a country a country. And so to ask a central bank to remove itself from the process of the innovation that's happening in that space, as we see behind us, is simply unrealistic to what's happening around the world. For better or worse, the central banks have made up their mind, and many of them want to do this. So the better question is about how to shape it safely. And I do believe that we can do these things together. And the truth is, and I don't know if everyone here will agree with it, I think CBDCs need stablecoins, and I think stablecoins need CBDCs. And the reason for that is that central banks do not want to be in the massive retail game, China aside. The Federal Reserve does not want to have 300 million customers it's dealing with. Retail stablecoins can play a huge role in this space, but there are core things, core government things that will retain a role for CBDC, and the standard setting ability, the transparency, the privacy that a CBDC can set from the Fed, from the European Central Bank, from the Bank of England, from the Bank of Japan, can influence the entire world. So we can't remove ourselves from that playing field. It can be a stabilizing force. It can be a force that brings more people into the entire digital currency ecosystem, from public to private money. And so that's the idea I'll leave everyone with.
Great. Well, thank you so much. I think I don't know if the folks out there listening are picking winners or not, but to me, we at the Stellar Development Foundation are winners because we get to work with all of you and have these conversations. My other big takeaway from this is that while the debate style is really fun, and this was really great to mix it up a little bit, let's do a podcast next time with no time limits. So thank you, each and every one of you, Josh, Dante, Simon, Alex. This was so great, and more to come. We got to keep talking about these issues. So I will pass it back to you, Justin.
Thanks. That was awesome. And I really do wish we had more time to devote to the conversation. And I think the podcast idea is great. It's surely a debate that's going to continue in the ecosystem and beyond for the foreseeable future. And again, Candace and Alex, Josh, Simon, Dante, thanks so much for participating, for sharing your expertise. We're definitely grateful for your thought leadership on the issue. All right, let's take a break. This one includes the first quiz of the day. And after that, we'll get into our third debate, the growth of Stellar. What happens next? It will definitely be fun. More in a moment.
Stellar has this wide array of assets, low fees, and the easy tooling that's necessary to build an app like Vibrant. Vibrant is a dollar stablecoin wallet based in Brooklyn, New York, that helps people in Argentina protect themselves from inflation. Brooklyn has an incredible crypto and fintech community of talent and resources as we're building out this crypto wallet on top of the Stellar blockchain. By building on Stellar as an extension of SDF, Vibrant has been able to implement innovative features, pioneer account recovery, and overall make it easier than ever to integrate with the network. The country of Argentina faces a significant amount of inflation with their local currency, the peso. And our goal is to help people escape that inflation and protect themselves from devaluation by giving them access to a stablecoin called USDC.
Inflation has impacted Argentines for generations, including my family, transforming Argentina into a dollarized country. Last year, in 2020, the inflation in Argentina closed at 36%. And this year, year 2021, it's projected to increase to 48%. This means that the peso can lose its value in a matter of days. This is in part why Argentines use currency exchange, and more specifically, they buy US dollars as a savings instrument.
Antes yo ahorraba, pero no llegaba a ningún lado. Era como que no, la plata, acá con el tema de la devaluación, no te sirve ahorrar de la inflación. Y viste que acá guardar pesos te lo consume el minuto a minuto, de minuto a minuto esto. Y el tema de la inflación no puedes hacer nada.
Due to restrictions in Argentina on the purchase of US dollars, Argentines have resorted to buying physical dollars on the street or on the black market and keeping them at home in what's called under the mattress, which is typically a drawer or what you feel is a secure location in your home, but in reality, this poses a great risk.
As an app, Vibrant allows you to load value in the form of a Argentine peso stablecoin called ARST, issued by our on and off ramp partner in Argentina called Settle. Users then are able to swap that ARST on Stellar's decentralized exchange for USDC and protect themselves from inflation. Stellar's ecosystem standards provide these standardized ways for wallets and for on and off ramps to integrate, as well as perform compliance. We had access to asset issuers like Settle and its ARST token, which allows us to spin up an on and off ramp in Argentina right away. At Vibrant, we've seen some exciting growth. We've seen a 10x improvement in conversion rates and a 60% month-over-month growth in average balances.
Cuando empecé a manejar mis gastos, un amigo me la recomendó y la verdad que en Vibrant me siento protegido de la evaluación y a salvo de todo lo que es la inflación. Lo que más me gusta de Vibrant es la capacidad de comprar una moneda equivalente al dólar llamada USDC y dejándola ahí todo el tiempo que quiera y sin preocuparme por la inflación en ningún momento. Siempre quise tener un podcast sobre tecnología y gracias a Vibrant empiezo a plasmar ese sueño en la vida real.
Being able to buy digital assets on a decentralized blockchain is very appealing. It is a growing trend as safeguard of value, not only in Argentina, but also in Latin America.
As we grow, we plan to add in other financial services that are available on the Stellar network, creating more financial inclusion through easier access to this new digital economy.
Okay, everyone, it is quiz time. To participate, click on the quiz tab on the right-hand side of your screen next to the live chat and submit your answer. First quiz question of the day. Who owns the Stellar network? Options are Jed McCaleb and David Maziris. No one. The Stellar Development Foundation. I'll be back in a couple of minutes to share the right answer and to introduce the next session, the growth of Stellar. What happens next?
Today, we're going to talk about the real-world use cases and how they relate to Stellar ecosystem protocols.
In this talk, we'll be talking about the anatomy of an SDK, and we'll be taking a journey through that.
Today, I want to talk about DeFi on Stellar Tours. But first,
we wanted to take this opportunity and walk you through the high-level design of Stellar Core.
And then we're going to look at some of the exciting ideas that we're considering next as we look to the future for Horizon.
I'm going to walk you through every wallet and anchor's favorite journey, the KYC journey that Vibrant has gone through.
We've been experimenting with Layer 2 to see if there are capabilities we could bring to Stellar users, specifically Stellar users who need to process large numbers of payments.
Along the way, we'll see how two new proposals, Cap 21 and Cap 40, make Starlight possible, simple, and efficient.
Okay, quiz takers. I'm back with the answer to who owns the Stellar network. Hopefully this was an easy one. The correct answer is no one. Stellar is a public blockchain. It's open source, open participation. It doesn't have an owner. It's like the internet. Anyone can build great things on Stellar. You don't need permission from SDF or any other entity to turn your vision into a reality. Next up, we have a debate about the growth of Stellar. What happens next? There have been a lot of advancements on the network over this year, and we've been talking about them all conference. But what does the future hold? That question is what this panel is all about. We're joined by leaders from some Stellar ecosystem companies to debate how payments are evolving on Stellar, the primacy of payments versus other use cases, the impact of AMMs, scalability issues, and more. Boris Reznikov, our Director of Business Development, is serving as our moderator and host. Boris, it is good to have you. Let's get this debate started.
Awesome. Thank you very much, Justin. Thank you, everybody, for joining. What an awesome show so far. It's been a pleasure to watch all the sessions. And thank you, audience, for joining today's debate around the growth trajectory of the Stellar network and what we expect for the network itself, as well as for the Stellar community and ecosystem in the months and years ahead. As Justin mentioned, I'm Boris Reznikov, your host for this session. I'm the Director of Business Development at the Stellar Development Foundation. And I expect to have a very lively discussion today with our esteemed panel of speakers. To provide some additional context on the topic, we know that tech platforms tend to be dynamic and adaptive. But I think this is especially true for a decentralized network like Stellar, where all of the participants, from the small developers that are hacking away in a garage, all the way to large corporations building production products on Stellar, can have a direct influence as to the direction that the tech takes as it grows and evolves. And this applies not just to the focus of the technology, what it's applied to, but also to the actual features and capabilities that the platform provides. And I'm particularly excited for this session because we've got an all-star group of debaters with me today. Each of them represents a business that is leveraging Stellar in its own way to solve very different problems. And so with that, I'll hand it over to our panel to introduce themselves. I'd love it if you could introduce yourself and provide a little bit of context on your company and what your involvement in the Stellar ecosystem looks like. Mary, why don't you kick us off, please?
Sure. Thank you, Boris. Thank you very much. My name is Mary Saraco. I am the founder and CFO of Settle Network. Settle is the largest cross-border payment company in Latin America. We focus specifically on settlements, cross-border settlements and remittance, and on fiat gateways, fiat on and off ramp in Argentina, Brazil, Mexico, etc. We are one of Stellar's anchors in Latin America. And if you have seen the video before this panel, you guys were seeing Vibrant, and we are the partner, the fiat gateway partner for Vibrant. And also, if you've seen the ARST, we are the issuers of the ARST, the Stellar stablecoin of Argentinian peso in Argentina. We're also one of Stellar's portfolio companies, and we're very, very happy to keep building on Stellar.
Awesome. Thank you.